Welcome back to the portfolio update. Today, I'm buying 8 different dividend growth stocks. Let's jump right in. The first stock I'm looking at is the Royal Bank of Canada. And as a fellow dividend investor, you are likely familiar with this bank. The Royal Bank of Canada is a Canadian multinational financial services company. It is the largest bank in Canada by market capitalization. It serves over 16 million clients and has over 86,000 employees worldwide. It's currently trading at $116 per share, has a market cap of over $166 billion, a PE ratio of 14.43, and earnings per share at 8.08. The current dividend yield is just below 4%. Looking at the share statistics, and because I'm interested in those dividends, 5-year average dividend yield has been just under 4%. The payout ratio is just under 54%, meaning there's plenty of room to invest money back into the operations and to continue to pay a growing dividend. It has revenues over $43 billion, and those revenues are growing over 3% on a quarterly basis. As a dividend growth investor, I'm also interested in the dividend growth rate. Currently, it has a 3-year growth rate of 5.95 and a 5-year growth rate of 6.73. You can see it's been a healthy dividend payer, continuously growing that dividend over time, with plenty of raises along the way. In terms of the financial, it's a growing bank, with revenues over $40 billion in 2017, growing all the way to over $47 billion in 2020. And the other important piece, there is plenty of free cash flow. And because of the funds I have available in my RRSP, I'm going to go ahead and pick up 1 share. The next stock I'm adding to my portfolio is Canadian National Railway. Canadian National Railway is a Canadian Class 1 freight railway headquartered in Montreal, Quebec. It serves Canada, the Midwestern United States, and Southern United States. It's currently trading at $146 per share, has a market cap of just under $104 billion, a PE ratio of 29.21, earnings per share at 5, and currently pays a yield of 1.68%. Looking at the stock chart, over the last 5 years, it's up 83%, and in the last 1 year, it's up 30%. And if I zoom out all the way, since 1997, this stock is up over 2,000%, and it's been paying those consistent dividends. Speaking of dividends, it has a 3-year dividend growth rate of 12.33 and a 5-year dividend growth rate of 12.84. So it's a healthy dividend growth payer. If you've been holding on to CNR, you have been rewarded with plenty of dividend rate increases. It has a 5-year average dividend yield of 1.66% and a payout ratio of 46%. So there's still plenty of room to pay that dividend. It has revenues just under $14 billion, and those revenues are also growing at 2% on a quarterly basis. Taking a peek at the financials, the revenues have gone from $13 billion in 2017 to just under $14 billion in 2020. And it has plenty of free cash flow. Because of the current market price, I'm going to go ahead and pick up 1 share in my RRSP. It's a great stock, plenty of growth coming in the last 5 years in terms of capital appreciation. And in those 5 years, it has also been growing its dividend. All things I like. The next stock I'm looking at is Restaurant Brands International. And if you don't know Restaurant Brands International, it is a Canadian American multinational fast food holding company with subsidiaries you have likely heard of: Burger King, Tim Hortons, and Popeyes. It's trading at $83 per share, has a market cap of just under $26 billion, a PE ratio of 52.25, and earnings per share at 1.6, and a dividend yield of just over 3%. In the last 1 year alone, it has grown over 50%. 5 years, it has grown just under 70%. And if you've been holding on to the stock since 2015, you're up 105%. And if you've been holding on to QSR, you have been rewarded with multiple dividend increases along the way, with a monster dividend increase of over 100% coming in 2018. And it has been committed to that dividend growth over time. Look at the company's financials. It had revenues of over $4.5 billion in 2017. They grew up until 2019, and because of COVID, the revenues are now below $5 billion. And once we get through COVID and more restaurants open up, this revenue figure is sure to go higher, especially given its ambitious expansion plans. And all throughout that, it has maintained a healthy and positive free cash flow. So I'm going to go ahead and pick up 1 share of QSR. The next stock I'm looking at is a dividend investor favorite, Enbridge. Enbridge is a multinational energy transportation company headquartered in Calgary, Alberta. It focuses on the transportation of energy, primarily in North America. The stock is currently trading around $46 per share. It has a market cap of over $94 billion, the PE at 31.54, and earnings per share at 1.48. And just look at that monster yield at 7.2%. So you can see why investors love Enbridge. And another reason why investors love Enbridge is not just because it has a monster yield at over 7%, but it can grow that yield. It has a 3-year dividend growth rate of 10.29 and a 5-year dividend growth rate of 11.71. If you've been holding on to Enbridge since 2004, your dividend has grown from 11.45 cents all the way to 83.5 cents today. It's been good to be a dividend investor with Enbridge. And because of the nature of their business, the industry they're in, this isn't a stock you hold for capital appreciation. Yeah, it has grown 18% in the last year, and since 1995, it's up 1,200%. But if you look at the 5 years, it's actually down 8%. This isn't something you should hold just for capital appreciation. This is a stock you hold for some capital appreciation, but really you're holding it for the dividend yield. And you're not just holding that stock for the dividend yield, but you're holding it with an expectation for that dividend growth potential. And if you look at the financials, you can see that revenues are down since 2017. They were at 44 billion, grew to 46, 50, and then in 2020 came crashing down to just over $39 billion. The one good thing is, even with a declining revenues, it's been able to maintain a healthy free cash flow. It controlled its investments in property, plants, and equipment, allowing it to manage its free cash flow. Now, typically when I'm opening a new position, I add in just one stock, but with a yield at 7% and a price at 46, I'm going to go ahead and pick up 3 shares of Enbridge. The next stock I'm adding to my portfolio is Granite Real Estate Investment Trust, another new REIT to my portfolio. And if you've never heard of Granite, Granite is a Canadian-based REIT engaged in the acquisition, development, ownership, and management of industrial, warehouse, and logistic properties in North America and Europe. And because of COVID-19, a lot of office properties took a major hit. And with the growth of e-commerce, there is a need for more warehousing, not just in Canada, but worldwide. So that's why I like Granite, because it's in a sector that I think has room for a lot of growth. It's currently trading at $78 per share, has a market cap of just under $5 billion, a PE ratio of 11.24, and earnings per share at 6.97, and a very reasonable yield of just under 4%. In the last 5 years, the stock has doubled, going from roughly $36, $37 per share to over $78 per share today. In the last year, it's also up 32%. So with this stock, you can get capital appreciation and dividend growth potential. It has close to a 20% return on equity and a 12.52 return on assets. This one is a monthly dividend payer, most recent dividend being 25 cents per share, and the dividend growth at 3 years at 3.57 and a 5-year dividend growth at 4.82. And looking at the dividend history, they've been known to increase their dividends between 3 to 6% over time. Looking at the share statistics, it has a healthy payout ratio of 41%. Looking at the financials, you can see how they've been able to grow their revenue from $222 million in 2017 all the way to over $340 million in 2020. And this number is only going to go up as the need for warehousing continues and as they acquire more properties. And even though they have negative free cash flow, I'm not concerned because they're investing that right back into the business. So with Granite, I'm going to go ahead and pick up 1 share in my RRSP. The next stock I'm adding to is Telus. This is not a new position for me. I'm actually adding to an existing position. The reason I'm adding to Telus is simple. 1, to average down on my position, and 2, pick up more of those dividends. Telus is known to be a healthy dividend payer with a 3-year growth rate of 6.44 and a 5-year growth rate of 7.07. You also get plenty of capital appreciation with Telus along the way. So I'm going to go ahead and pick up 4 shares of Telus. The next stock I'm adding to my portfolio is Couchstart. Again, just like Telus, not a new position, I'm adding to an existing position for the exact same reasons. 1, to average down, and 2, to pick up more dividends. And this stock has been known for dividend growth, with a 3-year dividend growth rate of over 16.67 and a 5-year dividend growth of 18.33. So if you're investing in ATD, you're getting growing dividends and capital appreciation along the way. So I'm going to go ahead and pick up 2 shares of ATD. With only $30 left in my portfolio, I also decided to pick up InterRent Real Estate Investment Trust. This is another REIT I like, again known for capital appreciation and known for growing their dividends along the way. So because I only have roughly $30 left, I'm going to go ahead and pick up 2 shares of InterRent. Now that I've updated my spreadsheet, I'm going to go ahead and walk you through the changes. Let's just refresh this data. So as you can see, today I'm up $3.21. I have 44 shares in my portfolio with 21 different holdings. The biggest gain seems to be coming from ECN, and the biggest loss for today is coming from ATD, a stock I just bought. But because I'm a long-term investor, I'm okay with these ups and downs because when a stock goes down, I'll happily pick up more as I've shown. Looking at my dividend calendar, I've added in some estimates between now and up until the end of July, August, so I can see the amount of dividends I can expect between now and the next few months, and also the individual yield with each dividend payment. I'm expecting to bring in $2.50 in April, $3.31 in May, $5.50 in June, and $2.50 in July. To me, what this shows is that even without investing a single penny, I can expect $15.32 of dividends to come in without me having to do anything. But obviously that's not the plan. The goal is to continue to add to this portfolio for an ever-growing stream of dividends. Here's all my activity that I've had since inception, all my trades, deposits, dividends. If you're interested in WealthSimple, make sure you sign up using the link in the description. If you do, you'll get a $10 bonus on your first $100 trade. That's an instant 10% return. So make sure you check out that link. Looking at my historical data, you can see that my portfolio has grown over time. It was less than $150 in February, grew to $800 in March, now just over $1,600 as of April. And because the markets have been going up, I had a loss in February, but that loss had now turned into a gain as of today. And the cool thing about collecting dividends is that my open return is 1.5%, but once I factor in dividends, my total gain goes up, and my total return is now 1.58%. So no matter how the market goes up and down, at least those dividends are there to come in. My largest positions now are CNR, Enbridge, and Telus. My 2 smallest positions are Empire, AQN, and Zin. And taking a look at my waterfall graph, and because the market has continuously gone up since February, all those losses that I had early on have quickly turned into gains. What used to be orange before, now is blue. So all these bars in blue represent individual gains from various stocks. So for example, I have a $3.35 gain in Magna, a $7.64 gain from Bitcoin, and some losses here, with my total gain coming in at $25.59. And here's a quick summary of my overall portfolio. So without dividends, I'm up $25.59. With dividends, I'm up $26.08. So far, I've collected a dividend from Telus for 31 cents and a dividend from Acon, 18 cents. The only losses in my portfolio is Zin, the Index Innovation ETF, and CNR, and everything else is pretty much in the green. Interested in easy money? I have links to promo codes in the description of this video. Not only do you get various sign-up bonuses and discounts, you also get to directly support the channel. If you have questions for me, feedback on this video, or maybe you have ideas on future content, leave them in the comments below. And while you're at it, make sure you hit that like and subscribe button. That's it for this video. I'll catch you guys in the next one.